Welcome back to the Dividend Diplomats YouTube channel. You got your boys here, Lanny and Bert, the Dividend Diplomats. Today we're going to cover 5 stocks that may be facing a dividend cut. Guys, with tariffs coming, with earnings getting slashed, these 5 stocks may be forced to make a tough choice and cut that dividend.
Guys, hit that subscribe button. Give us a nice thumbs up. 5 stocks here. The market crash. You guys been buying the dip because we've been buying the dip. But you know what? My dip is some of these dividend income producing stocks. They may dip that dividend lower if things don't change for the better here. Some of you might be surprised that there are some concerns from Bert, but others you'd say, yeah, no brainer just by looking at that dividend payout ratio. That's safety to the dividend. And guys, when times get tough like right now with the uncertainty around tariffs, you want to go to quality and safety, lower debt, lower payout ratio, higher quality. Let's look at what Bert's got here together.
Yeah, that's exactly right. So let's level set here for a second. The dividend payout ratio. It is one of our most important metrics that we follow. It's one of the items in our dividend stock screener. We look at it because what it is pretty simple, Lanny. Dividends per share divided by earnings per share. How much of your earnings are you paying out? That's what it's all about. So we pulled that for each of these 5 companies in here from Seeking Alpha. Why are we so focused on this payout ratio, Lanny? Because you can't pay out a dividend that's larger than earnings in the long run. So if a payout ratio is above 100%, Lanny, odds are at some point that can't be sustained and that dividend's going to keep coming down.
That's right. There's only one place to go if it's already not sustainable. You throw in a lot of uncertainty surrounding higher cost, something that's going to impact earnings. The payout ratio is already in a bad shape. Now it's in worse shape, possibly. Then there's one thing that can be done by a company that has reduced the dividend. There is the retainage of earnings, but then there's also B, cash flow. And cash flow will be so important here during this time period, guys, from a debt standpoint, from an ability to borrow standpoint, ability to continue to pay your current obligations here, guys. So again, stock market crash so far, well needed, well deserved, well received by dividend investors. But for these 5 stocks, it makes you think how safe that dividend is. Will we see a reduction, or is this just a short-term blip and they'll come out just fine?
Yep. So we pulled in from Seeking Alpha the yield, payout ratio, 5-year dividend growth rate. Now there's increasing. And then we're going to just comment here on a scale of 1 to 10, 10 being the highest. How concerned are we for a dividend cut for each one of these? So let's kick this off here, Lanny. Let's jump right in. Let's go to that first stock here. This one may surprise you unless you watched a video we had about a month ago where we talked about this company. Number 1 is Texas Instruments, ticker symbol TXN. The semiconductor favorite has been one of my favorites in my portfolio for quite some time. They've increased that dividend for 19 years. They've had that 10% plus dividend rate. However, lately, that payout ratio, Lanny, has been climbing. In that video, we talked about how that payout ratio was getting close to 100%. That was before tariffs were announced. That's before expenses were adjusted to result from tariffs from what they're going to pass on to consumers. So the question is, Lanny, can that dividend be sustained right now? What is that payout ratio from Seeking Alpha today?
Well, right now with the payout ratio on Texas Instruments, again, ticker symbol is TXN with only a 3% yield, but that payout ratio is 103%. They were over 100%. We did feature that, as Bert said, on an earlier video. I never like it when a company is at or above 100%. And I don't think anybody here watching loves that. I mean, who's outside of your REIT? This is not a time that you want to see 100% payout ratio.
A lot of their dividend growth is banked on the fact that next year's earnings are going to be great. But we don't know if that next year earnings forecast where you see a payout ratio drop has anything of what's happened in the last week baked in. So if that's the case, how long can Texas Instruments, in an industry that's getting crushed right now by tariffs, and an industry that's in the limelight?
Well, it's funny because the yield isn't showing that there's a risk of a cut.
No, it's not. But how long can they hold in there? So that's why I went through my dividend cut meter that I put together 1 through 10, where 10 being the highest, where I think there could be a very high likelihood of there being a cut, Lanny. I'm giving Texas Instruments a 5. I'm giving them
Okay.
a 5 because you're right. That yield doesn't have the cut priced in right now, but who knows if this type of environment sustains for 2025, Lanny? They continuously have multiple years of 100% payout ratios. Texas Insurance might be forced to cut the dividend, and they're going to have to figure out where to invest their cash to help avoid the tariffs and everything that's going on right now.
At 3.47% on that yield for Texas Instruments. I mean, again, not screaming like, oh yeah, if there was a dividend cut, you would have thought that it would have been probably in the 5 to 6% range. Obviously, they've fallen with the rest of the market. So, all right, I could see where you're at with 5. But bro,
Yeah.
you had 5 stocks. We got to get to number 2 here. This is a
Yeah.
stock that a lot of us own. You own, I own. Many people own.
This one may surprise you, and this may surprise a lot of people here because they are down from their highs significantly just a few weeks ago. We're talking Starbucks, ticker symbol SBUX. Their yield is at 2.88%. That payout ratio from Seeking Alpha is 76%. They've increased that dividend for 14 years. So why is Starbucks, Lanny, on this list? Well, they're getting hit with tariffs on multiple fronts, Lanny. They're getting hit with tariffs on the price of coffee. You're going to see price from their products going up. So, I mean, their cost of goods sold are going to go up. So they're going to have to raise the prices somewhere. But also, a lot of Starbucks growth, Lanny, isn't domestic in the US based. A lot of their growth story is international and in the heart of China, in the heart of where the major issues are ongoing still. So a 76% payout ratio doesn't give you a lot of room to have costs go up for your product to eat a lot of that margin and then also face issues on the top line. That's why Starbucks is sitting here on this list.
Right. I mean, obviously not what you want to see here. Starbucks. I mean, the payout ratio is not the worst, but if that starts getting beaten down and compressed even more, and if they're trying to turn around, they probably want as much cash flow to continue to rejuvenate the business. And they've got a lot of headwinds right now.
They do. So on this rating, I'm going to give them a 6. I'm going to say the panic meter for Starbucks is a 6 overall. So let me know what you guys think. So far, we have Texas Insurance at a 5, Starbucks at a 6. Number 3, Lanny, on this list has the lowest payout ratio, but has by far been the most volatile stock right now in this tariff battle.
Yeah, we're talking about Nike, guys. Ticker symbol NKE. This has been a darling of a stock being talked about all over social media, all over X. I will admit I did not purchase this stock. And, if you were buying in the 80s and 70s, it's at $54 at the time of this video. So you would have lost, quite a bit of value there.
Yeah.
And right now with tariffs, that doesn't usually do well for Nike, considering where their shoes are typically made.
Yeah, and they're not going to bring stuff over. So they're much like Lanny, your comment you made about Texas Instruments, how you feel like a lot of the pricing isn't into the yield, how there's not a lot of volatility going on in the price to show the impact of tariffs. Nike is very much reflecting that with that price there in the price now in the 50s. They are swinging wildly right now in every piece of news. So that just leaves me to think with everything that's happening, the yield climbing, even though their payout ratio at the moment is 50%, who really knows what earnings are for Nike with that price dropping so much? I think the market's telling you something that the analysts aren't producing on these aggregator websites just yet.
I understand why you have it as an 8 out of 10 on the risk factor here because of the deep headwinds within their cost and cash flow structure. And it's almost like, has Nike lost their touch? I don't know yet. They've been through so much, the iconic legacy stock. Let us know what you guys think of Nike on a 1 to 10, 10 being extremely risky on the dividend. Let us know what you guys think the risk level is with Nike. Do you see a reduction to the dividend, or do you see, wow, this is like a 3%, almost the dividend aristocrat stock that's going to be right back below 1% yield in 5 years because you're going to have this insane performance from Nike stock. So let us know below.
Yeah, so stock number 4 on this list, UPS, ticker symbol UPS. I guess the company's name is United Parcel Services. So 84% payout ratio. nearly 7% dividend yield. UPS was struggling before tariffs, before economic uncertainty. They were dealing with the high union costs. They were battling declining revenue. They were kicking Amazon to the curb as a major customer. They were in the middle of a strategic turnaround. So, on top of that, Lanny, let's throw in economic uncertainty. Let's throw in what people buying less goods. Let's throw in companies shipping less stuff because of all the chaos that's going on in there.
Layoffs? Did somebody say layoffs?
Layoffs. So the payout ratio, again, 84%. We don't really know how much earnings have been adjusted to reflect it. But sometimes companies, for better or for worse, will use situations like this, and economic uncertainty is a perfect scapegoat to do something that they've wanted to do but haven't had the cojones to do themselves. So could UPS use this, to the tariff war, the economic uncertainty, to cut the dividend, right size it, and help improve the company's cash flow?
I see you've rated this one on a 7 out of 10. I might have considered swapping this with Nike. But let us know, do you guys think UPS will demolish the dividend downward, given the labor union increase of cost, the different ordering shipping mix that they have, and them exiting by themselves the Amazon low margin business?
Mm-hmm.
I actually think that's going to be beneficial to UPS, just because I
Sure.
think they'll be able to have better earnings from a margin standpoint. It's especially if they, laid off some people to offset the cost
Yeah.
of what they needed to, fulfill that Amazon service. But yeah, I think they're a little. I think 7 to 8 is probably fair here. I haven't been adding to UPS. If you guys know, I own 100 shares of United Parcel Services, so I have not been adding.
Yeah. Again, it could be an ends to a means for the company to help them improve that position. So we'll see. Last on this list is a dividend king. Their dividend king that's increased their dividend for 56 years. This is my highest one on the panic meter, Lanny. I think this one's a 9 out of 10 for a company
That's
that
wild.
could cut its dividend. Their payout ratio is sitting at 74%, but who knows if that's really been adjusted. They produced a lot of their goods in Canada. They produce things for DIYers, for people that probably aren't going to be running to buy new tools anytime soon. We're talking.
Maybe they don't want to get it done by somebody, so they want to do some more in house because it saves money.
Maybe we're talking Stanley Black and Decker, ticker symbol SWK. Have I also mentioned they produce a lot in China, which I know I already did, but have I also mentioned they have a lot of debt to throw in on top of it too? So this is a levered balance sheet. To me, this company, it something is going on with what's been reflected in that stock price, because it's dropped significantly. Stanley Black and Decker, I don't know where it closed today. I look at it now. It closed today at 58.68. Lanny, its 52-week high was 110. It is down heavily from that 52-week high. Ever since the tariff war started, 5 days, it's down 3%. It was down in the mid 70s when the rumors of the tariffs really started to take hold. So,
Dang. SWK guys, let us know if you own
yeah.
the stock. Let us know if you've been adding to your stock position here, or if you think it's too risque to add more shares.
Mm-hmm.
Um, yeah, I think in that 8-9 range makes a little bit of sense. I think between them and UPS, obviously, I think no matter what, shipping will happen. People will order goods.
Mm-hmm.
So, I think the majority of people here in the United States are still going to have shipping happen. I don't know. I might have to say, I think Stanley might be fine if this is like the worst as it gets, and they just muddle through here until next year. I don't know.
Hey, I hope you're right. I'm not advocating for a dividend cut. I'm just saying what I think might happen. So to summarize, the 5 companies today were featured: Texas Instruments, Starbucks, Nike, UPS, and Stanley Black and Decker. All are showing signs of a potential dividend cut if earnings collapse. If tariffs are a long-term thing and can substantially alter the business, it could substantially alter your cash flow if you are an investor in these
Yeah.
companies.
Obviously, we're not here to say run out to go buy these stocks. We're not sitting here to say run out and go sell these stocks. You guys definitely got to make your own decisions here. on these 5 stocks, but let us know if you have been buying the dip on these 5 stocks. Very curious where you investors have been, trying to buy and add to your stock positions.
If you haven't already, subscribe to the channel, give this video a thumbs up, and remember, you're either with us or you're against us, Jack.
That was Bert and Lanny from the Dividend Diplomats. Over and out.